Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is Fergus Hodgson at the New Orleans Investment Conference 2019. I'm always so pleased to be back and to have so many fascinating people. I have here the lovely Danielle Dimartino Booth, the author of Fed Up, a book about the Federal Reserve, and the founder of Quill Intelligence. And she has been sharing her insights as a former Federal Reserve employee based in Dallas and what can be done. So Danielle, what motivated you to write about the Federal Reserve, and what is your key theme or advocacy point?
So I think that the Federal Reserve has been losing its way, if you will, since dual mandate was implemented in 1977. And that is when Congress voted to add the employment mandate to the Federal Reserve, which greatly expanded what they consider to be their duties. And I don't think that Alan Greenspan or Ben Bernanke or Janet Yellen would have kept interest rates as low as they did for such a prolonged period of time. We've all heard the term lower for longer, had they not been trying to get that marginal employee off the sidelines. So I've always advocated for the initial step to reform the Federal Reserve being taking it back to what most central banks around the world have, which is just an individual inflation mandate to maximize the buying power of the dollar. So I think that that would be a good first step, and that's my main point of advocacy.
I mean, that's just so logical, because having two mandates that seem to conflict with each other, and then even a third, because if you look specifically at the written mandate or description of what the Fed's role is, they're all supposed to have, I think, is it low interest rates? They have almost a triple mandate. Regardless, it's just the case that if you have multiple mandates that conflict with each other, obviously it's confusing for them and for people who are trying to observe. And has there been any willingness, either in Congress or in the Federal Reserve Board itself, to adopt just a simple straight inflation mandate?
There have been many in Congress and in the Senate who have had an eye towards reforming the Fed. Unfortunately, quite a few of them have left. And your average politician is always going to advocate for the Fed's mandate to be as wide as humanly possible, because the wider the mandate, the lower the interest rate tends to be, the easier it is for the country to borrow and spend. And that is, as a country, what our politicians simply love to do. It's run up the debt. As you know, we just passed the $23 trillion mark a few days ago, indicative of the fact that the government likes to borrow and spend. And now the Federal Reserve is buying up $60 billion a month in a new program that they refuse to call quantitative easing, but now they're effectively monetizing the debt out to the 1 year mark. So I can't see anybody in Congress wanting them to stop doing that, even though for the long-term health of the economy, it's toxic.
I want to just emphasize to people what this $23 trillion in debt, at least this is the stated, we all know there are off-budget or unfunded liabilities as well. If there are 300 million Americans, that suggests $60,000 per person in debt. And this is simply the federal level. Forget state, municipal, everything else, and forget unfunded liabilities. Every single person in the United States right now has a $60,000 debt, and that's just out of control. But in terms of the toxicity, many economists I hear and read that there's a sense that once you get beyond 100% of GDP in debt, that it starts to encroach upon economic growth. Since the United States at least appears to be beyond that, does that mean that lower growth is just to be expected now?
Well, I certainly think it's more and more difficult to squeeze $1 of economic output from every dollar of debt that's created. Now, I will say this much. My good friend Lacey Hunt at Hoisington Asset Management out of Austin has done some really lovely groundbreaking work that shows that the United States actually gets a lot more efficacy from the debt that it creates vis-a-vis Europe, for example, or the worst case of all is China, where they get the least amount of stimulus for every dollar of debt that they push through their economy. But the point is, it's still decreasing, and we have passed 100% of GDP, and we have indeed seen economic growth slow appreciably. You know, we were growing at 3%, now we're growing at 1.9%. Expectations for the fourth quarter of 2019 have now come down, according to the Atlanta Fed, to 1.1%, or the New York Fed to 0.8%. So we're seeing a clear deceleration in U.S. growth, potential as we continue to rack up all of this debt.
Yes, so at Quill Intelligence, they have two levels of subscription, as far as I know, daily, $50 a month, and then another one is, would you want to explain actually the subscription options?
Sure, of course, yes. So we have the Daily Feather, and that is something that we publish every trading day, and the material can cover anything from, we were just speaking about the Swedish central bank wanting to get out of the negative interest rate regime. They've discovered, lo and behold, that it does not do anything to propel economic growth, but that it only propels debt. But we'll do anything from that to what is going on with U.S. data across a full spectrum, and that's a $50 a month subscription. And then we have the Weekly Quill, which is a much deeper, intensive weekly dive for institutional investors if you're running money, if you're a strategist, if you're a hedge fund manager, if you're a CEO, and that is $5,000 a year. I've been doing that for over 4 years now.
That's great. And whenever I hear this notion about getting bang for the buck from debt, it does seem to be a widely held assumption that spending is production. And I don't know whether you want to weigh in on this maybe economic debate about whether we should be focused on demand or supply, but it's just a peculiar assumption to me that if we spend more, the assumption is we must be producing more, and naturally that logic leads us just to keep spending more and more. Is there an impediment to what would be the problem with the Federal Reserve increasing interest rates and the federal government cutting down on this fiscal deficit to the U.S. economy? Would this have to be done in steps, or basically what I want to know is what is the tension, if there is it, between not having all this monetary expansion and actual economic growth?
Well, so I think that the great fear, and it is a grounded fear, it is with reason that the government fears a rising interest rate regime, because it would indeed put the economy into a deep recession to have normalized interest rates. I think we got a flavor for that by seeing how incapable the Federal Reserve was of bringing interest rate, even up to the 3% level, for example. So I think that this great big debt bomb that is ticking in the background would blow up. And I think that the country would indeed suffer a deep and prolonged recession in order to get past it. But think about the alternative. And we've had not one but two cycles that have been increasingly unproductive. During the housing bubble years, for example, we had 4 out of every 10 Americans either directly or indirectly employed by the real estate industry. Very non-productive endeavor for a decade or so. And what have we done in the current cycle? Well, we've financialized the entire U.S. economy. So rather than investing in the future, CEOs have literally been trained in a low interest rate regime to buy back their shares. And we've seen capital expenditures collapse, and we've seen investment in the future collapse as well, while other countries that have been more fiscally prudent have been putting money into things like infrastructure and making sure that their countries are going to grow over the longer term, and we've been peeling away at our future prosperity. So it won't be easy to step back from generating growth via spending that's created with debt, but I think it's necessary for the country to take that painful step.
Explore, discover, develop. The Gold Newsletter podcast is proudly sponsored by the Discovery Group, an alliance of public companies focused on the advancement of mineral exploration projects with a proven track record of generating exceptional shareholder value through responsible, sustainable, and innovative development. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello there, listeners. We have a special offer for you. Go to goldnewsletter.com/bonus to get Brian London's top 2 mining stock picks and his Golden Opportunities newsletter. That is goldnewsletter.com/bonus. You mentioned that you compile all this data or process it in your publication, and one of them you said one that you found most interesting is the disparity between CEO optimism or CEO confidence and consumer confidence. And right now, my understanding is that the disparity with CEOs much less confident than consumers is stark, maybe starker than you've ever seen. Why is this, and what does it mean?
So we call it the Quill Intelligence Outlook Gap. And we took the data back to 1976 so that we could see it over several cycles that importantly did not include an overly intrusive Federal Reserve. And over time, as soon as that CEO confidence is at the extreme in terms of being well above that of consumers, you will start to see a turn in the unemployment rate. It's intuitive in the sense that the worker bees of the economy, if you will, the Jane and Joe workers are they're the last people to find out that the economy is slowed enough such that the boss, the CEO, the executive has already been planning on writing pink slips. But again, they know what's coming. They're the people who are facing cost cutting, and the easiest place to cut variable costs is indeed in labor, and we've seen this especially with protracted decline in backlogs on the services side of the economy and the manufacturing side of the economy. Backlogs you can think of as future demand. If your future demand is decreasing appreciably, then you're going to have less need for employees going forward. But I don't think the employees have clued into this just yet.
Often on the show we discuss this, the fact that there's been basically a drawn-out recovery for more than a decade now since the Great Recession. But no one really has timing as to when there might be the next correction. And many of our guests will refer to what's called the everything bubble, that there's basically a bubble or an over-speculation throughout the economy. And do you have a sense for when there will be a correction and its nature, which particular sectors will be most swiftly impacted, and how will the Federal Reserve catalyze this? There's so much going on there. Basically, I guess the one question is, do you have a sense for timing? How long this expansion can continue, what might interrupt it, and when that happens, what will be the most severely impacted sectors?
There were quite a few events that prolonged the current economic expansion and made it into the longest in U.S. history. People forget that the U.S. automobile sector was already in recession in September of 2017, right before Hurricane Harvey hit Houston. And that economic effect was so tremendous as to pull the U.S. auto industry out of recession. There was a huge oversupply situation in Houston commercial real estate and in housing and in apartments and in hotels. That vanished almost overnight, and you brought a lot of the construction workers throughout the country who had been waylaid off the sidelines. This was followed by the tax bill at a time that the economy was late cycle. There were a lot of critics at the time who were saying, boy, we sure should be reserving that dry powder for a rainier day. A tax cut of this magnitude at the end of a cycle is simply ludicrous. And then on top of that, you have the tariff and the outbreak of the trade war that pulled a tremendous amount of demand forward and propelled the economy through the end of 2018 to very high levels. But I would argue that these three different events injected the economy and prolonged the current expansion. Now we're on the other side of that mountain. And what the Federal Reserve, because the Federal Reserve is now the only game in town, how much money printing they can do to prevent the recession from coming, I think is questionable at best as we head into year end, because they've already had to increase the amount of liquidity that they're injecting into the markets. They've got quantitative easing in the purest sense of buying treasury bills out to 1 year. That's already at $60 billion. So I don't know how long the confidence can last, but I certainly do think that Jay Powell wants to prolong this for as long as possible. I don't see it happening. I see the U.S. being in recession by the end of this year or early 2020. But then you never know what the power of liquidity is going to be. If he can, and when I say he, I mean Jay Powell, if he can keep the stock market levitated, then he can prolong this expansion.
It is very peculiar, and so many people have observed that at such a low level of unemployment, still going for monetary stimulus. If monetary stimulus is designed to increase employment and increase our engagement in the economy, at what point do we say, actually, we're engaged enough?
Well, and that's the thing. The idea that you should eradicate the business cycle, I think, is very weak. I think that it's fallacious, and I would prefer that the Federal Reserve would allow cyclicality to re-enter how the United States economy operates, because you end up with inefficient operations. You end up with an overcapacity issue throughout many sectors. Just look and see how much money's been thrown, for example, at the energy sector. And you end up with sectors and being financed by private equity and other endeavors that simply make no long-term sense in terms of increasing productivity. And that's really where you want economic growth to go. So, it's time. Unfortunately, it is time to let this cycle through and move on to the next one.
And yeah, your book is Fed Up, and I do not have it in front of me, I'm sorry, but there are people buying it here. I saw it. It's in popular demand. What is the subtitle? And since it came out, which I guess was a couple of years ago, have you seen an impact?
Well, I'm pleased to say that Fed Up, and the subtitle is An Insider's Take on Why the Federal Reserve is Bad for America. I'm sad to report, actually, that there's been a resurgence in interest in the book since the Powell pivot of January the 4th. 2019, when he went from being a seeming hawk to making Mario Draghi look like the world's biggest hawk, now that he's become basically the sugar daddy of the financial markets and cranking up the printing press as he has. But it continues to be very well received, and it's looked at as kind of a financial literacy primer, because so many people used to, consider the Fed to be this big black box and not understand it. And I think that policymakers would have preferred to have kept it that way, and that I had not written the book. But it is written in plain English, and it has certainly introduced central banking and the Federal Reserve to many readers around the world, and I'm delighted to say that it continues to sell.
I know maybe this is beyond your area, your comfort zone, but do you have any confidence that there will be competitive pressure with the rise of alternative currencies on the Fed to reform, basically to stave off competition?
This is how I look at cryptocurrencies in general. And it's actually why I don't think that we can end the Fed. I think that if you look at what the Chinese have done to U.S. intellectual property, I can only imagine what they would do to our financial system if it was completely unpoliced. But if you look at the three pioneer countries in cryptocurrencies on the sovereign level, that's China, Venezuela, and Russia. And when you consider that they're going to be in the electronic currency space and we're not, that simply doesn't work. That does not hold together. I think it's going to be another matter of national security for there to be Fed coin or something of its ilk, so that we can be present in a market that is an inevitability on the global stage. So I think we'll have to go there. I just hope that we still have the alternative of having paper currency as well in our wallet, as opposed to having every last purchase monitored by a central entity. That does not make me.
That's right, and actually there's a great deal of concern about that ironically to some, cryptocurrencies may undermine our privacy rather than heighten it, because cash is the ultimate private form of exchange, because you can even have it one way. If you drop your cash in someone's envelope or whatever, he doesn't even know where it came from, right? So it is very private. There are alternative currencies seeking to address that, but they're in early stages, so who knows what will come of that. We are at an investment conference, and so naturally the question from people here is, this is great observing, calling for reform, wanting to see a more robust U.S. economy. Yet at the same time, we want to know, how do we actually interpret this and respond to it, right? So people here are particularly interested in precious metals, but are there any asset classes that you see as holding up in the long run when, let's say, the next recession hits?
Well, so I certainly think that there are some demographic plays that you can make. I don't think healthcare, if you can play it right and at good valuations, is going to be an industry that goes away with the aging of the baby boomer population. I think cybersecurity is going to be increasingly critical in a world that is digitizing at a very rapid rate. And I think that there are also, believe it or not, states and municipalities that are very prudently well run, fiscally conservative. I personally own quite a few municipal bonds in some of these places that do run a tight ship, and I think that that is going to be one of the safe harbors for my portfolio, in addition to my precious metal holdings.
Okay, now just your website. What should we put up on the Gold Newsletter podcast?
I'll be happy to share the Outlook Gap Daily Feather with you, so you can put that up there, and quillintelligence.com is the website.
So go to quillintelligence.com, and she's also active on Twitter. We will include links to that. All the sources are at goldnewsletter.com/book. podcast. Otherwise, thanks so much, Danielle.
Great to be with you today. Thank you.